Breaking news, markets just opened down 700, almost 800 at the open. Dow on track for its worst week since the financial crisis. After a disastrous week on Wall Street, can anything stop the bleeding at this point? Joining us now to break it down, Neil Irwin, senior economics correspondent for the New York Times, Damian Paletta, economics editor for the Washington Post, Dom Chu from CNBC, and Dan Nathan, both back with me. Dom, you're on the floor. Another rough start. What specifically are you looking out for today? Because right now it feels like a falling knife.
All right, well, we're watching for any kind of stabilization. Speaking of those falling knives, it's a situation where you think that after a drop of this size and magnitude, again, the fastest that the S&P 500 has ever fallen by 10% from record highs, it only happened in the span of 6 days, and that's catching a lot of folks' attention. There was a thought this morning that things might stabilize just a little bit, but that's not playing out so far. What we will be watching for to see is if anything develops on places outside of the stock market. We're watching the interest rate picture. Remember, government bonds in the U.S. side continue to be one of those preferred investments. As those bond prices rise, interest rates fall. So ironically enough, President Trump and his administration are getting the lower interest rates that they've wanted, even on longer term debt. The other place we're going to watch, too, is whether or not policy starts to take fold in any way, shape or form outside of what we've already seen. The reason why I say that is just in the last few moments or so, the Federal Reserve of St. Louis President James Bullard has made some comments in a speech he's making in Arkansas saying that he does not think, and I will read this for you verbatim, this whole idea of whether or not rate cuts are in play. Further policy rate cuts are a possibility if a global pandemic actually develops with the health effects of coronavirus approaching the scale of ordinary influenza. But this is not the baseline case at this time. So a voting member or a member of the Federal Reserve is now saying that they could see interest rate cuts if this gets bad. But for right now, they're still holding pat. But that uncertainty playing out in a big way again today, Stephanie.
Okay, but Dan, are rate cuts really a solve for this? Rate cuts spur growth. They get people to go out there and start a business, buy a home. This is about a possible pandemic that's basically going to stop all consumer spending. How does a rate cut solve this?
Well, it doesn't do anything, and I think there's been a lot of debate about it. I mean, at the end of the day, the Fed had this, what they called a mid-cycle adjustment last year. They had 3 consecutive rate cuts in the middle part of last year. And
with no crisis in sight.
With no crisis, and it really just tells you how fragile I think the economy was here. And it also shows you right now with the stock market careening lower, how dependent the stock market has been on lower rates. So at the end of the day, over the last 2 quarters, Q3 and Q4, GDP, gross domestic product, that is supposed to, the rate cuts are supposed to help. We're really trending below the 3-year average. So they're not likely to help here. What really I think a lot of people are going to start to focus on, what would a fiscal sort of stimulus do to kind of help the U.S. consumer if we do see some sort of economic stress caused by the disruption from the virus?
Hey there, I'm Chris Hayes from MSNBC. Thanks for watching MSNBC on YouTube. If you want to keep up to date with the videos we're putting out, you can click subscribe just below me or click over on this list to see lots of other great videos.